2.27. Come to problem number 6. Page number 2.27, problem number 6. The balance sheet of New Light Limited for the year ended 31st March 2010 and 31st March 2011 are as follows. Balance sheet of New Light Limited for the year ended 31st March 2010 and 31st March 2011 are as follows. Fixed assets 32 lakh, 38 lakh. See here, order is given differently. You are given last year figures first and then you are given latest figures later. So you have to be very careful. It's not current year's figures first and last year figures next. Ulta they have given. Old figures they have given first and new figures they have given next. So you have to be very careful with this, okay? Because you will get confused. You will treat every increase and decrease then, okay? Depreciation, investments, cash and other current assets. Equity share capital, 10% preference share capital, capital reserve, general reserve, profit and loss account, 9% debentures, current liabilities, proposed dividend, provision for tax and unpaid dividend. Additional information. The company sold one fixed asset for rupees 1 lakh, the cost of which was 2 lakh and the depreciation provided on it was rupees 80,000. The company sold one fixed asset for rupees 1 lakh, the cost of which was 2 lakh and the depreciation provided on it was rupees 80,000. The company also decided to write off another fixed asset costing 56,000 rupees on which depreciation amounting to 40,000 has been provided. The company also decided to write off another fixed asset costing 56,000 on which depreciation amounting to 40,000 has been provided. Depreciation on fixed assets provided 3,60,000. Company sold some investments at a profit of 40,000 which was credited to capital reserve. Debentures and preference share capital redeemed at 5% premium. Company decided to value inventory at cost, whereas previously the practice was to value inventory at cost less 10%. The inventory according to books on 31st March 2010 was 2,16,000 and the inventory on 31st March 2011 was correctly valued at 3 lakh. Prepare cash flow statement as per revised accounting standard 3 by indirect method. Okay, so you have to prepare the cash flow statement. Before we start, we have to make a small adjustment to the balance sheet. See that point number 6. The company decided to value inventory at cost, whereas previously the practice was to value inventory at cost less 10%. Then the inventory according to books on 31st March 2010 was rupees 2,16,000. The inventory on 31st March 2011 was correctly valued at 3 lakh. Last year, inventory was valued at 10%. The closing stock was valued at 10% less than cost. Now we want to increase the value and we want to show last year's stock also at cost. So if last year's cost was 100, less 10%, we showed the stock at 90. So 2,16,000 is equal to 90. Find out how much 100 is equal to. How much is it? 2,40,000. Just type on your calculator. 2,16,000 divided by 90%. 2,40,000. 2,40,000. What is the book value on 31st March 2010? Last year, we have valued the same stock at only 2,16,000, whereas the value of stock was 2,40,000. So we have to increase the value of stock by how much? 24,000. So what we do is, with pencil or with pen, change the value of other current assets in the balance sheet. You will say 11,10,000 plus 24,000. 11,10,000 plus 24,000. If I increase asset side, something on the liability side also has to be increased or the balance sheet will not tally. So go to the P&L account balance on 31st March 2010. You have 2,40,000 there. Add 24,000. and listen to me carefully. We are assuming during the current year stock valuations are all right. Opening stock, closing stock, all the valuations are right. There was a mistake only in the valuation of closing stock of last year, which we have increased the value of closing stock and we have increased the value of profits. Is it clear? Now we can start solving the problem. So now listen to me carefully. To start the cash flow statement, we require net profit before tax. Yes, but in this problem, net profit before tax is not clearly available. We have to search for net profit before tax. And you can see profit and loss account opening balance and closing balance is given. If you compare, what will you find? Surplus of the current period. So from there you have to work backwards, add back dividend, dividend distribution tax. If there are any transfer to reserves, add back, you will get net profit after tax. Add back provision for tax, you will get net profit before tax. Start preparing the cash flow statement. Come in. This is third class or fourth class on cash flow statement? No, third. Okay, today is fourth. Come in. I am not preparing for myself. Quickly note it down. Harish, you have become a watchman. You only. I am concerned who is coming, who is going. ఎక్కువ నవ్వకు, నిన్ను కూడా అంటాను ఒక రోజు. My teacher used to say the same thing to me. And I used to be student, somebody come. Let us start. So we don't have starting point. So as our approach goes, we go by balance sheet items and read the additional information and start fixing items in the cash flow statement. Okay. Equity share capital last year 12 lakh, current year 16 lakh. Be careful. 12 lakhs to 16 lakh. It has increased. 4 lakh. 4 lakh. It has increased. Please tell me, do you have any other adjustment relating to share capital? No. So we have to assume it is issue of shares for cash. Proceeds from issue of shares 4 lakh. Inflow. Preference share capital. Last year 4 lakh, current year 2,80,000. There is a reduction in the preference share capital. It is possible only because of redemption. See the additional information given to you. Point number 5. Debentures and preference share capital were redeemed at 5% premium. Debentures and preference share capital were redeemed at 5% premium. That means we have redeemed preference shares worth face value 1,20,000. But we have paid 5% premium, 1,20,000 plus 5%. It is 1,60,000. Sorry, 1,26,000. Just do it on calculator. 1,20,000 plus 5%. 1,26,000. This is the amount we have paid. Redemption of PSC. 1,26,000. Now, when you redeem preference share capital, we actually pass certain entries. Preference share capital account debtor 1,20,000. Premium on redemption account debtor 6,000. To preference shareholder 1,26,000. When you are going to make the amount due, you will pass the entry. Preference share capital account debtor 1,20,000. Premium on redemption account debtor 6,000. To preference shareholder 1,26,000, and then you pay the amount. Preference shareholder account debtor to bank 1,26,000. The outflow has been captured. Now what about the premium which you paid at the time of redemption? There are two options. One, if you have available securities premium, you are going to debit it to the securities premium account, because section 78 of the old act provided premium, securities premium can be used to pay premium at the time of redemption of preference shares or debentures. So you can debit it to securities premium account. If securities premium account is not available, then you have to write it off by either debiting the profit and loss account. Yes. So in this problem, can you see any premium on redemption on the debit side of the balance sheet? Can you see premium on redemption on the debit side of the balance sheet? No. That means that account has been closed. Where would have been transferred to be closed? It would have been debited to the profit and loss account. Is it an operating expense? Is it an operating expense which has been debited to the profit and loss account? No. It is a non-operating expense, Hence we are going to add it here. It has been debited to P&L account. It is non-operating in nature, hence we are adding it back. Okay. Next. Capital reserve. Last year 0, current year 40,000. See point number 4. The company sold some investments at a profit of 40,000, which was credited to capital reserve. So the story of capital reserve will come to know later. So now need not worry about it now. Next, general reserve, last year 6 lakhs, current year 7 lakhs 60,000. Open general reserve account. Brought down 6 lakh, carried down 6 lakh, carried down 7 lakh 60,000. Next, profit and loss account. Last year 2 lakh 40, not 240, 264, current year 3 lakh. What is the difference called as? In Schedule 3 language, we don't call it as P&L account balance, we call it as surplus. Surplus last year was 2,64,000. Current year it is 3 lakh. So there is an increase in surplus by 36,000. We use it for calculation of net profit before tax. Net profit before tax, question mark, less tax provision, question mark, net profit after tax, question mark, less dividend, question mark, less transfer to reserve, dividend proposed, transfer to reserve, question mark, surplus carried to balance sheet. What is the surplus now? 3 lakh minus 2 lakh 64,000. 36,000 is the surplus. I would like to ask you one question. Is premium on redemption a tax deductible expense? No.
Yes, sir. Yes, sir. That's why we are adding to the non-operating expense.
Premium on redemption of debentures. We'll search for the answer and I'll also tell you. Okay? Because I'm also searching. Continue. Next. 9% debentures. 9% debentures. 4 lakh and 2 lakh 80,000. 4 lakh and 2 lakh 80,000. So what happened to the debentures? Debentures also have been redeemed. 4 lakh and 2 lakh 80,000. Redemption of debentures. I think point number 5 you read. Debentures and preference share capital redeemed at 5% premium. So redemption of debentures. $1,26,000. See, again we pass the same set of entries. 9% debentures account debtor 1,20,000. Premium on redemption account debtor 6,000. To debenture holders 1,26,000. Then when you pay the amount, debenture holder account debtor to bank 1,26,000 is the entry you pass. What about that premium? Is it appearing on the balance sheet asset side? No. That means it has been written off. It would have been debited to the profit and loss account. It's a non-operating expense, hence you have to add it back. Premium on redemption of debentures 6,000. See, that question is irrelevant, Shravan, whether it is before tax or after tax, because we are going to start from the bottommost number in the P&L account. We are going to reverse all the in-between items and we are going to arrive at operating profits before depreciation, all these adjustments and tax. We want to ultimately reach a point where we show sales minus cost of goods sold minus operating expenses, operating profits before depreciation, interest, other items and tax. So whatever items are there, we are going to just add it back. My question was whether it will save tax for us or not is a question we have to find out. Accounting wise, it doesn't make a difference. Next. So what about interest on debentures? That is not my question. Interest on debentures. Paid, not paid, should we handle in the cash flow statement or should we ignore it? There is no mention of any interest on debentures anywhere in the problem, no? But percentage is given, bhaiya. It is 4 lakh into 9%. How much is it? 36,000. I'll assume the debentures were redeemed at the end of the year. So we have to pay full interest for the entire year. 4 lakh into 9%. How much is it? 36,000. Okay. Sometimes question will not say interest was paid. So we have to find out. Interest expense. 36,000. Why am I adding here? Non-operating in nature. Interest paid. 36,000 outflow. Interest expense. Interest paid. Next. Current liabilities, 4,80,000 last year, current year 5,20,000. There is increase in current liabilities, which is cash inflow. Increase in current liabilities, how much? 40,000 cash inflow. Next, proposed dividend. Last year 1,20,000, current year 1,44,000. Proposed dividend, we don't treat it as a current item. We open a separate account for proposed dividend and then we try to find out how much was paid really during the year and how much was provided. What is it out? No, I am assuming debentures were redeemed at the end of the year. So you will not pay interest. Year पूरा use कर लिया पैसा. इंटरेस्ट नहीं देगा क्या? इंटरेस्ट दे के भेजेंगे वापस. See whether it, according to me, my assumption is more reasonable. Timing of the redemption is not given. So I'm assuming at the end of the year. If you say at the beginning of the year, right, it was assumed that debentures were redeemed at the beginning of the year. Hence, I have provided interest only for the remaining debentures. Next, proposed dividends. Last year 1,44,000. Current year, last year 1,20,000, current year 1,44,000. You have one more tail account. There is one more tail account, unpaid dividend. How much? 16,000. So let us open both the accounts together. Proposed dividend, unpaid dividend. Both the accounts. proposed dividend, unpaid dividend. Tell me what is the opening balance? 1,20,000. Closing balance? 1,44,000. Unpaid dividend brought down 0. Closing balance how much?
16,000.
16,000. I think yesterday I told you scheme of entries. How come the 16,000 came? From where did the 16,000 come? Out of 120, we were unable to pay 16,000. We were able to pay only 1,04,000 to unpaid dividend account. So out of this 1,20,000, amount transferred to unpaid dividend was 16,000. So here you have transferred. Okay. Now tell me, out of 120, if we have not paid 16, we would have paid 1,04,000. So entries proposed dividend account return to bank 1,04,000. Story of last year over. But how come do you have this balance again? 1,44,000. Dividends were provided for the current financial year. What is entry you write? P&L appropriation account debtor to proposed dividend. In schedule 3 we don't have P&L appropriation account. Surplus account debtor to proposed dividend. By P&L appropriation 1,44,000. Now have the accounts got reconciled? Out of 120, 16 was unpaid, transferred to unpaid dividend account, paid 1,04,000, provided for 1,44,000. Look at the board everyone. This is one item which is relevant for cash flow. This is also one item which is relevant for cash flow statement. This is dividend paid, this is dividend provided for. Dividend paid, financing activity. $1,04,000. Dividend provided for out of current year profits. This working note is waiting. It is crying net profit before tax. Please fill it up. 1,44,000. That's it. Next, provision for tax. Last year 3,40,000, current year 3,60,000. See the adjustment. Okay, current year 3,40,000, last year 3,60,000. Do you have any adjustments relating to tax? No. So what do we assume? Last year tax was paid, current year tax was provided for. So what was the last year's tax? 3,60,000. 3,60,000 paid. Tax provided for. Where do I show tax provision? Here. How much was tax provided? 3 lakh. Last year liability discharged. Current year liability provided. Unpaid dividend story we have done already. Next, come to asset side. Fixed assets. You have opening cost and closing cost. Opening accumulated depreciation and closing accumulated. Whenever you see such information, immediately open to accounts. fixed assets account and accumulated depreciation account. Open fixed asset account and open accumulated depreciation account. Debit, credit. Fixed asset account brought down. Opening balance, tell me how much is the opening balance? 32 lakh. Opening balance. Closing balance at cost? 38 lakh. Accumulated depreciation, opening balance 9 lakh 20,000. Closing balance 11 lakh 60,000. Now read additional information relating to these two accounts. What does the problem say? The company sold one of the fixed asset for rupees 1 lakh, the cost of which was rupees 2 lakh, and the depreciation provided on it was rupees 80,000. You are given sale price, you are given cost price, you are given accumulated depreciation. Prepare asset disposal account. Prepare asset disposal account. Prepare asset disposal account. Tell me what is the cost price of the asset disposed? 2 lakh. So out of fixed asset, transfer 2 lakh to asset disposal account. How can you transfer? Credit this account, debit this account. So by asset disposal 2 lakh, asset disposal account, 2 fixed asset 2 lakh. What is the accumulated depreciation on this asset? So remove 80,000 from this account and transfer it to this account. How can you remove? This is showing credit balance. Remove debit, credit. To asset disposal. How much? 80,000 by accumulated depreciation 80,000. Now tell me what is the sale price of this asset? 1 lakh. Bank account debtor to asset disposal account. By bank 1 lakh. By bank 1 lakh. So this is a loss of how much? 20,000. Transferred to profit and loss account. It's not below line adjustment. It is above line adjustment. That means adjustment was done before net profit, before tax. If adjustment is done below this, we say below line adjustment. From here, whatever is adjustment is done above line. From here, whatever is done is below line. Okay. So, to P&L account. Sorry, by P&L account. Loss, no. By P&L account, 20,000. P&L account would have been debited with 20,000. Listen to me. The net profit before tax we don't know. Whatever profits we get here, it is after suffering that loss of 20,000. If that loss was not there, you would come to understand that cash flow from operations were higher. Okay. So we have to add it. Loss on sale of machinery. Loss on sale of asset. 20,000. Next. The company also decided to write off another fixed asset costing 56,000 on which depreciation amounting to 40,000 has been paid. I'll do that. Company also decided to write off another fixed asset costing 56,000 on which depreciation amounting to 40,000 has been provided. So another asset was disposed, it was actually written off. That means you were not able to sell it. Okay. So open one more asset disposal account. Now before we go to the next disposal account, here we have forgotten to record one transaction. Sale of asset 1 lakh should be shown as an inflow in investment activity. Sale of asset 1 lakh inflow. We have captured both the items relevant for the cash flow statement. Come in. Next, one more asset disposal account, or you can simply say asset written off account. Asset written off account. Asset written off account. What is the cost price of asset written off? What is the cost price of asset written off? 56,000. So right here by asset write off account 56,000, asset written off account to asset 56,000. I have removed the cost price of asset written off, transferred it to a separate written off account. This is also like a disposal account. But the only problem is you are not going to get any money. Remove depreciation also. How much is there? Asset write off account 40,000 by asset by accumulated depreciation 40,000. Now are you able to sell this? No, it is written off. That means worthless. WDV is 16,000. 56 minus 40. WDV is 16,000, but it is written off. That means entire amount is debited to the profit and loss account by P&L account. By P&L account 16,000. Asset written off. Add back. Why add back? That loss should have been debited to P&L account. No. Is it an operating loss? No. Hence add it back. Is it a cash flow? It's not a cash flow. Depreciation on fixed assets provided during the year 3,60,000. Provided. What is entry right when you provide for depreciation? P&L account at R2. Provision for depreciation account. Here I write by P&L account 3,60,000. Depreciation debited to profit and loss account is a non-cash item. Hence it has to be added back. 3,60,000. Depreciation provided. Next. That's it. I think there are no other adjustments relating to fixed assets. Let us check whether there are any acquisitions during the year. 32 lakh minus this and minus this. To find that there are some purchases during the year. What is the value of assets purchased during the year? To bank. 8 lakh. Tell me how much?
8,56,000.
You have not had breakfast today. 8,56,000. Balancing figure. Purchase of assets. Outflow. Is the depreciation account tallying? Depreciation account tallies. Sharat Chandra. Is it tallying? Next. Investment account. Last year 4 lakh, current year 3,20,000. Investment has reduced by 80,000, and we have some adjustment also. Company sold some investments at a profit of 40,000, which was credited to capital reserve. Please open investment account. Either of these three accounts. Right here, investment account. Debit, credit, brought down. What was the opening balance? 4 lakh. Closing balance? 3,20,000. See the adjustment? Company sold some investments at a profit of 40,000, which was credited to capital reserve. What was the profit? Company sold some investment at a profit of 40,000. So there is a profit of how much? 40,000. Credited to capital reserve. Debited to investment account. So investment account will give a debit to capital reserve. 40,000. This is profit on sale. Is the account tallying? No. So by bank 1 lakh. Balancing figure. See, investment account is maintained at cost. 4 lakh minus 320. Cost price of investment sold 80,000. Profit 40,000. 80 plus 40. Sale price is 120. Asset accounts, investment accounts are maintained at cost. Okay. If they increase, that means there is a purchase. If they decrease, that means there is a sale. But you get only the cost price of the sale. You have to add profit or subtract loss to arrive at the sale price. Okay. Next, I think did we show relevant cash flows? Wait. Sale of investments, inflow. $1,20,000 inflow. Profit on sale was credited to capital reserve, not to the profit and loss account. Next, cash. Opening balance 10,000, closing balance 10,000. Next, other current assets. Last year 11 lakh 34,000. Current year 13 lakh 10,000. Last year 11 lakh 34,000. Because you have changed the figures, no? With pencil I made you to write plus 24,000. 1134 minus 1310. How much is the difference left? How much? 1,76,000. Ah, fantastic. Increase in current asset. What is it? Outflow. How much? Over all the other information we have consumed. So let us start closing the accounts one by one. Working notes. General reserve is still waiting for your attention. General reserve, it is still waiting for your attention. Till now we have not found any adjustment relating to general reserve. Opening was 6 lakh, closing was 760. So how can you explain this difference? So where did the balance increase? Profits were transferred to general reserve. P&L account at not P&L. P&L appropriation account at to general reserve. So here you write by P&L appropriation 1,60,000. Look at the board. This working note is waiting. Transfer to reserve. How much was transferred to reserve? 1,60,000. Now everything is complete in this working note. Go in the reverse direction. How much? 6 lakh. Net profit before tax 6,80,000. Tell me what is the 11,24,000 before working capital changes. After working capital changes, 9,88,000. After tax,
6,28,000.
ah, Santosh is back in form. 6,28,000. 6,36,000. Negative. You. Financing activity. 8,000. What? Positive, negative?
Positive, sir.
Total cash flow.
0, sir.
I am not good at completing chapters very quickly. Come to page number 2.30.